Good afternoon. I'm acutely aware that I'm standing between you and lunch, so I'll make this crisp and quick. Okay, so I'll pick up and carry on the same theme, which talks about energy in the new era. But it'll be infused, if you like, with 20 years in investment banking across Africa, London, and now in Central Asia, where I now call Kazakhstan home. And we have the good fortune in Kazakhstan of dealing across border with China and following hot on the heels of 15 years in Africa. What I want to do is try and introduce, if I may, Spiros, a fourth D, which I suspect will have to be included more and more into the sector's analysis, and that is that of the dragon, the Chinese dragon emerging along with enormous balance sheet capacity. So I think it's up to me to drive. Okay, so in about 7 or 8 deals that I've dealt with in China at sort of international level, there are about 7 factors that I've picked up, and I'd like to just go through those today. The first one is the immense power of the Chinese balance sheet, and I think we'll start to see that as they begin to reshape geopolitical investments across the world. We're already seeing it, of course. I'll also touch on briefly how China's balance sheet is actually helping us to reshape the global ranking of industries. And within those industries, in particular the energy industry, they're reshaping completely the way that we go about doing our business within energy. And perish the thought that the Chinese do deals unimaginatively or badly. In fact, they do them exceptionally well, and I'll just give some insight into that. And then since 2015, China has actually been included as a global reserve currency, and that's given them access to huge amounts of liquidity. Lower cost of capital, for those of you who are involved in any way in structured finance, will know lower cost of capital results in higher asset prices, enabling the Chinese to outbid on exactly the same assets against most of their competitors. So the Western challenge basically is turning into one which the outlook for the energy sector is one which is going to be strongly biased towards the shape that China gives it over the next 10 to 15 years. So just a couple of pointers, if you like. What we see is that between 2004 and 13, China's overseas investments increased about 14 times, from 45 billion to 600 billion. Starting in 2010, only 2 Chinese banks, China Development Bank and Exim Bank, outspent the World Bank on an annualized basis into developing economies. In 2014, China single-handedly spearheaded the BRICS Development Bank, the Asia Investment Bank, and the Silk Road Fund, comprising upwards of 100 billion investment into the Silk Road. Basically, since the 1980s, China, the BRICS, which used to comprise about 5% of global GDP, now comprise approximately 20 to 25%. If we look at the outward foreign direct investment, what is clear is that Europe is picking up about 8% of that. 60 to 70% is going into the neighborhood of Central Asia. Kazakhstan, of course, is one of the beneficiaries through Kashagan and Karachaganak. Russia also benefits with about 30 to 50 billion in terms of loans for oil, and Latin America about 15. As I said, China drives a hard bargain. In return, they get about 75% of their fossilized imports from Africa and Central Asia. There is one anomaly here, and that is that the amount of money which is coming out of China, approximately, we'll look at some of the numbers in an instant, there's about 50 billion which has gone through to Russia, and 5 billion which has gone through to Brazil to buy refineries, which is not included in the foreign direct investments. And that is effectively because China is washing most of its money through its offshore tax havens. So what you're seeing in terms of foreign direct investment from China is actually understated. Africa has obviously been one of the most transparent beneficiaries of outward foreign direct investment. And I would suggest that the one thing that is missing at a conference like this, perhaps, is a consideration of what might China look like as a business partner for this kind of forum. just to give you a sense of how China is reshaping the industries, this is what the comforting view of what industries look like in 2005. The headlines are pretty simple. We rank these by sales, profit, assets, and market value, equally weighted, come up with their scoring, and you'll see comfortingly 5 US top oil and gas top companies, 4 European companies, 2 British and 2 Dutch, with 1 Japanese company in the top 10. Fast forward 5 years, and we see the first introduction of a Chinese institution into the top 10. Fast forward another 5 years, half of the top 10 companies are Chinese. And heaven knows what the next 5 years will look like. But they're certainly not going to look like the previous 5. So what we're seeing is the sheer immensity of Chinese spending is going to reshape not only the industries, the ranking of those industries, but also, I suggest, the energy industry. If you look at the expenditure and the levels of expenditure that are being undertaken by China, run your eye along the Chinese line. About 40% of total direct investment into new projects, and in this you include some, as I already mentioned, some of the Kazakh and Russian deals, along with the Venezuelan loans. About 40% of total expenditure in the coal, oil, and gas industries is undertaken by China. 31%, 90 billion per year, undertaken by China into the renewables. And here in Europe, quite often, the numbers that we're speaking about are simply fractions of that. So, bordering with China in Kazakhstan, negotiating with them extensively in deals, what we're seeing is huge investments in renewables and oil and gas, perhaps a slight underinvestment in infrastructural spend, but still coming in about 20% of total expenditure in the industry. So China does these deals, and they do them extremely well. What we are seeing, and I've analyzed about 750 deals that China has done across the world, they're effectively underpaying other buyers by about 15% for comparable resources. And one of the reasons for that is China goes to risky places. They use a low cost of capital, as I've already mentioned, to try and increase their asset values and their bargaining power. They introduce cheaper lending, cheaper funding, and participate in equity structures. Those two things enable China to go to risky places and actually reduce prices relative to competitors. From a strategic perspective, the bad news for developed markets is that China seems to have learned, if you like, from failed oil and gas deals in the West. For example, the failure of the Unocal deal in 2005, the successful deal of Nexen in Canada, for example, saw China struggling to extract value from these Western deals. And so what we're finding now is that China is increasingly investing in higher risk areas where they're able to extract earlier returns. In terms of the energy outlook from China's perspective, we expect that over the next 5 years, I'm doing some work with the Chinese university at the moment, that the installed new capacity by 2020 is going to contribute approximately 50% to the mix. Nuclear is the one variable which they're not being transparent on at the moment. By 2020 will come from renewables. Solar energy is slated to receive 150 billion of spending, about 90 billion per year into renewables, of which 150 over the next 3 years will go into solar. Job creation. China has said that it wants 13 million. It already has 10 million in the renewable sector. It wants 13 million people employed in the renewable sector. And having said that, the displacement, as we've already seen this morning, of renewables into oil and gas will still only see it account for 15% of the total overall energy mix because of the difficulty of displacement that's already been touched on. The expectation is certainly by 2020 that more than half of the nation's installed power capacity will continue to come from coal. Also, what we are seeing is a lot of pressure within China, and in fact globally, for products with energy baked in. And we'll speak about this just in a one-line throwaway. We're expecting cars, roof tiles, photovoltaic generation, home generation, and storage products are going to have to start to include the capacity for generation. So I've taken pretty much a much longer term view of strategy within the sector by looking at what the future might look like in a slightly longer term. Certainly we expect that China is going to compete very aggressively in terms of foreign direct investment, which either, depending on how you structure the deals with China, can either be an opportunity or a productive partnership. Certainly the deals that I've done with them, I found them to be extremely reliable, tough negotiators, but really worthwhile at having on board. The oil industries, we've already seen 120 billion in upstream mergers and acquisition over the past few years by China. What we're seeing is much bigger emphasis on Russia and Turkmen gas, and China's pushing that to try and change their energy mix domestically and try and clean up their reliance on on coal. LNG, it's already been mentioned today that the LNG industry is likely at a turning point. China recognizes this, and so we see them very keen for equity participation in LNG, and that's some of the projects which have already been mentioned and mooted this morning. Renewables, we see them transforming the mix over the next 10 years, and the energy sector within China is expected to be absolutely transformed over the next 15 years. In the next 25 years, which is the time frame that China seems to be planning out, the objective, and this is again a throwaway line from a Californian conference that I went to, the intention is that we try and bake more and more generative capacity into products rather than actually sucking it out of a generational system at country level. So the pressure that's going on within China at the moment is to try and generate the rural areas with localized generation. So these are some of the trends that we are seeing, and I think when Spiros and I discussed the need to look at a future era of energy, we decided to shift the focus a little bit to one of the countries that is fundamentally reshaping the industry for us. Thank you.